Hello everyone. Today we'll talk about market crash. Everybody's saying expect a market crash. If you open Instagram, you open YouTube, you'll find people putting curves on each other and saying we're almost there, we're going to hit the crash and all of this. First of all, what I want to say is market crash, nobody can expect it. It happens in an unexpected way, but there are indicators that are lagging and leading that we can look at, which usually the Fed look at. And I have built a way to look at it, based on 20 indicators that I will take you through to explain how I look at it. But how people are looking at it is mainly they are looking at Warren Buffett and the indicator of Warren Buffett, which is he looks at the market cap versus the GDP. However, this is outdated way to look at things because now currently with globalization, almost 50% of the revenue of these companies of the S&P 500, especially the top 10 companies, comes externally from outside the US. So this makes this indicator is a bit outdated and we shouldn't look at it as much. It's a good indicator to have there, and I have it into my platform and my terminal that I built, but it's not the main thing that we should look at for market health. There are so many other indicators, including, for example, the bonds in general, 3 months to 10 years. So this percentage is one of the things that the Fed looks at as well. When we look at unemployment rates and all of these things matter when we look at holistically the full indicators. I built something that helps me monitor to see where are we in the market. We're between fair valued and overvalued, not super overvalued, and we're not at a critical stage. And I will share this with you so you can as well know how I think of things. And I don't want you to miss out on opportunities, but at the end, you need to make your own decision. And if you have followed Warren Buffett, for example, before the bubble.com into the year 2000, from year 1997, Warren Buffett has been saying bubble, remove the money, and he lost 3 years of investment. He did great. He's an amazing investor, and Berkshire Hathaway, amazing company, huge performance. I'm not here to criticize. I'm here to say that maybe we have missed an opportunity if we pulled money out a little bit later. Also, the same has been the reality since 2017. So since 2017, Warren Buffett has been saying we are inflated, bubble, concentration risk, and all of this. So if you pulled your money out of the market from 2017, you have missed on almost 200% rally in the S&P 500. So these are the factors that we need to consider. I'll share with you now my analysis, the 20 indicators that I use to give me at the end what is the weight of them, at the end what is the judgment based on the weight of every aspect of them to give me how I look at the market. It's a very useful tool, and I hope you like it and use it as well for yourself to make your own decision about investment and when to pull out money or keep money. And as an advice at the end, they always said in case of crisis, in case of market collapse, what Warren Buffett is doing is the correct way. So the best hedge is to have cash. Why? So you rebuy from the bottom. So you reduce the time drastically. So usually S&P 500, in the most times when it fell, it took around 5 to 6 years to recover from its bottom. So if you had 40% of your portfolio, 50% in cash, and you bought it out, you reduce this period drastically. So this is basically what I wanted to share with you, and here we go to the platform and my terminal. So welcome everyone to the R.TERMINAL by Offchart, and here is a terminal that I built to focus into many parts of the market. I looked at it from a valuation perspective and macro perspective to be able to make a decision, and I distributed the weight based on my own conviction. So you'll find that there are many factors that are extreme. When I look at the market, there are many factors that are fair. There are many factors that are undervalued, like the VIX, for example, the fear indicator. Overall, the market, yes, was heating up. So it was almost at 66 recently, which takes us to the overvalued sector. However, currently it started falling, and we're now at the fair value. And how this improved, it comes from many sectors. So it comes from the equity risk premium, which looks at what is the government bonds rate versus, which is people look at as a risk-free rate, versus what is the market return. And currently with the market return improving and also dividends improving and all of these parts, so when you look at it, you'll find that it improved. So this was before, for example, in overvalued sector. Now it's in the fair sector. When you look as well at the VIX, you'll find that we are in a very good, healthy state. We are not in a fearful place. When we look at the gold versus the SPY, which is the S&P 500, you'll find that as well it is fair at score 50. Copper as well. We're looking at many aspects to see how is the situation. The RSI is actually bullish, so it's 69, so people are buying, and there is a high conviction towards the S&P. Where it really lags is the market cap versus the GDP. So the market is at 273%, which means 2.7 times the total GDP of the US market. Again, 50% of the revenues comes externally from outside the US. So this fails to capture this part. And when we look at the macro trends, you'll find that there are many healthy aspects overall. So when we look even at, for example, now the oil, you'll find that in general, it is now within the fair range, more towards the as well. It's more a bit towards the overvalued, but overall, because it's declining, it's falling now, and we're expecting to hear great news today about the situation of Strait of Hormuz and the political situation between the US and Iran. So this is expected to be amazing. Also, when we look at the other factors that we have here, including the 10-year treasury, the 10-year to 3 months spread, and all of this, you'll find that these are important indicators that I look at. This has never failed to show, in general, a leading factor to the recession and to the pre-demise of the S&P 500 falling 50% and 45%, which is a big kill to your investment if this happens. So this is in the overvalued section. If it goes to the high level of a score of 80, it's a situation where it probably will be heading to a recession or a stock collapse, but we're looking at other factors as well. So when we look at the industrial production year over year, so it's fair. There's growth overall. When we look as well at the headline CPI, so when we look at the consumer pricing index, it's 3.9. So it's fair. The governments usually prefer it to be between 2 to 3%. It's a bit higher than what the governments want, but the next reading is coming in 11th of June. So this is something to watch out at. So this is how I overall look at the indicators. This is how I look at the market. There are parts that are, yes, is in extreme situation. There are other indicators that are in a good situation and good rating, and it's actually in the safe margin. So when you look at all of these aspects and you decide how you want to put the weight as well of each indicator, this is how you make a decision into the investment and how to calibrate your profile. So I started seeing many people going towards more cash and waiting for the crash. Again, it's your own decision. My personal decision is no, I will not pull out right now. Maybe later on, especially when I look at the indicators that have never failed to show recession and the bad times of the economy, like the 10-year to the 3 months spread, if it goes towards the score of 80 or more and starts to flash red, maybe I'll start increasing my cash on the side pile to be ready in case of any drastic changes. So these will matter a lot. If CPI goes higher and we went to 4.5, which looks like it after the PPI reading, so producer pricing index was much higher than what expected. So if this goes higher, and as well the 10-year to 3 month spread of the bond yields as well went higher, this will be a very important indicator to start taking precautions. Please let me know as well what do you think of the dashboard and the market health dashboard, and how you manage in general to see and judge the market from your own perspective. Would love to interact with your comments.